Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Waters Corporation Annual Report. Waters Corporation offers a wide range of analytical workflow solutions to various industries worldwide. The company operates through two main segments, Waters and TA. Under the Waters segment, it provides liquid chromatography and mass spectrometry, MS, technology systems, including chromatography columns and consumable products. The company also designs and manufactures thermal analysis, rheometry, and calorimetry instruments for predicting the suitability and stability of various industrial, consumer goods, and healthcare products. Additionally, it develops software-based products that interface with its instruments as well as other manufacturers' instruments. Waters Corporation's products are used by a diverse range of customers, including clinical, pharmaceutical, biochemical, industrial, nutritional safety, environmental, academic, and governmental organizations. These customers utilize the company's products for research and development, quality assurance, and laboratory applications in various fields such as drug discovery and development, disease process analysis, nutritional safety testing, and environmental monitoring. The company's services include designing, manufacturing, selling, and servicing its instruments and software-based products. Its MS technology is used in a variety of applications, including clinical trial testing, protein analysis, nutritional safety analysis, and environmental testing. Overall, Waters Corporation provides a comprehensive range of analytical workflow solutions to support various industries and research applications. Unfortunately, I don't have access to the text you provided. However, I can still provide a general essay on what might cause a company's stock price to drop. The stock price of any publicly traded company can fluctuate significantly over time due to various market and economic factors. One major reason for a decline in stock price is poor financial performance. If a company fails to meet its earnings expectations, investors may lose confidence in the company's ability to generate profits, leading to a decrease in demand for its shares. Another factor that can contribute to a drop in stock price is negative news or events affecting the industry or market as a whole. For instance, if there are concerns about regulatory changes, economic downturns, or increased competition, investors may become risk-averse and sell their shares, causing the stock price to decline. Additionally, internal issues such as management changes, scandals, or product recalls can also negatively impact a company's stock price. If investors perceive these events as detrimental to the company's long-term prospects, they may choose to divest their holdings, further depressing the stock price. Lastly, external factors like changes in interest rates, inflation, or global economic trends can also influence a company's stock price. For example, if interest rates rise, it may become more expensive for companies to borrow money, leading to decreased investor confidence and lower stock prices. In conclusion, there are several reasons why a company's stock price might drop over time. Understanding these factors is essential for investors and analysts seeking to make informed decisions about their investments. Waters Corporation market capitalization of $31 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that Waters Corporation holds a significant advantage in their industry. Waters Corporation trades at a higher price-to-earnings ratio of 29 times and a higher price-to-book ratio of 7.26 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The company maintains a moderate leverage profile, with liabilities making up 50% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. Although shareholder equity has increased, the share count has risen while revenue is declining. This raises concerns that equity growth may be driven by dilution rather than business performance. The sustainability of the business model remains unproven. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. Net income and profit margins changes. The net income of the company experienced fluctuations between 2023 and 2025. In 2024, it decreased due to lower customer demand in China. However, in 2025, it increased by 10% compared to 2024, despite being affected by trade tensions and tariffs between the U.S. and China. The increase was short-lived, as net income decreased again in 2025 due to higher tax payments associated with the final 2018 tax reform transition payment. Profit margins also underwent changes during this period. They were initially affected by increased costs of doing business in China due to tariffs and trade policies. In 2025, profit margins decreased further due to higher selling and administrative expenses. The operating profit margin specifically decreased from 28% in 2024 to 25.4% in 2025. The changes in net income and profit margins can be attributed to various factors such as lower customer demand, trade tensions, tariffs, tax payments, and increased competition. These factors highlight the challenges faced by companies operating globally and the need for them to adapt quickly to changing market conditions. The company's financial performance indicates a consistent trend of generating positive operating cash flow. According to the data, the company generated $653 million in net cash flow from operating activities in 2025, which is a clear indication of its ability to produce cash from its core operations. This positive operating cash flow has been sustained over multiple years, with the same amount being reported for 2024 and 2023. The consistency of this trend suggests that the company's business model is generating sufficient cash to meet its operational needs, thereby confirming its ability to generate positive operating cash flow. The company's debt level and interest expenses have undergone significant changes in recent years. One notable trend is the decrease in interest expense, which has been reduced by 30% in 2025 compared to 2024. This decline can be attributed to various factors, including lower average outstanding debt, timing of borrowings and repayments, and interest rate cross-currency swap derivative agreements. The company's long-term debt has also seen a decrease, from $1,626,488 in 2024 to $947,445 in 2025. Furthermore, the notional value of interest rate cross-currency swap agreements has decreased, while the fair value of these agreements has increased. This increase in fair value has resulted in an accumulated other comprehensive loss related to interest rate cross-currency swap agreements. In addition to these changes, the company's weighted average interest rates have also decreased by 0.37% in 2025 compared to 2024. Overall, these developments suggest that the company's debt level and interest expenses have undergone significant reductions, indicating a more stable financial position. The company's performance varied across different segments and regions. On a positive note, Waters Biosciences emerged as a global leader in life sciences and diagnostics following the acquisition of BDS businesses. This move not only enhanced the company's scale, but also broadened its capabilities and expanded its presence in attractive end markets. In terms of revenue growth, Instrument Systems stood out with an increase from $1,278,695,000 in 2024 to $1,345,642,000 in 2025. However, other segments struggled. China witnessed a significant decline in sales due to lower customer demand, resulting in poor performance for the region. Furthermore, the company incurred approximately $9 million of severance-related costs in 2025 in regions not specified. Additionally, America's Other, which includes Canada, Latin America, and Puerto Rico, experienced a decrease in long-lived assets from $2,632,000 in 2023 to $1,971 in 2024. Lastly, while chemistry consumables saw revenue growth, the rate of increase was lower compared to Instrument Systems. These mixed results indicate that the company still has areas for improvement and needs to focus on addressing these challenges to achieve overall success. Management's outlook for the company is marked by a mix of challenges and opportunities. The company faces significant risks related to conflict minerals, regulatory obstacles, and disruptions in operations. However, management is taking proactive steps to mitigate these risks through investments in employee development, health and safety programs, and innovation. The company's future success depends on attracting and retaining highly skilled employees, as well as investing in new technologies and bringing them to market. Management recognizes the importance of protecting intellectual property and managing supply chains, which are critical challenges for the business. The competitive landscape is also transforming due to potential changes in ownership, mergers, and consolidations among competitors. Despite these challenges, management remains committed to driving growth and competitiveness through innovation and strategic investments. However, they acknowledge that there are no guarantees of success, particularly with regards to refinancing debt and managing financial obligations. Overall, the company's outlook is cautious, but management is taking proactive steps to address the challenges ahead and position the business for long-term success. The company's capital return policy has been active in recent years. In 2023, the company made a significant move by buying back $12 million worth of its common stock. This indicates that the company is committed to returning value to its shareholders through share repurchases. In addition to the 2023 buyback, the company continued this trend in 2024. It not only repurchased another $13 million of common stock, but also had a remaining authorization of $1 billion for future share repurchases. This suggests that the company is committed to ongoing share buybacks as part of its capital return strategy. While there is no information provided on dividend payments, the company's focus on buying back shares indicates a clear preference for returning value to shareholders through this means. Concerns about inventory buildup and supply chain disruption. The company's financial reports highlight several concerns regarding inventory buildup and supply chain disruptions. One of the primary concerns is the potential for excess or obsolete inventories due to decreased customer demand, increased competition, regulatory challenges, tariffs on Chinese goods, and uncertainty surrounding future trade policies. Page 19. This concern is further exacerbated by the risk of longer sales cycles, order cancellations, and delays in worldwide financial markets. Page 20. The company's supply chain is also vulnerable to disruptions caused by supplier shutdowns, capacity constraints, labor shortages, transportation delays, and cost inflation due to energy, raw materials, and component shortages. Page 25. Additionally, the prolonged inability to obtain certain materials or components could have a significant adverse effect on the company's financial condition or results of operations. Page 26. The impact of tariffs and trade policy changes is also a concern for the company's supply chain. Pages 38-39. The increase in inventory levels can be attributed to higher tariffs on material costs, as well as an increase in safety stock levels to mitigate future supply chain issues. Page 41. The company estimates revisions to its inventory valuations based on technical obsolescence, historical demand, and industry conditions. Page 44. The data also shows a significant increase in inventory levels from $477 million to $572 million between 2024 and 2025, with excess and obsolescence provisions recorded at $6 billion in 2025 compared to $14 billion in 2024. Page 56. These concerns highlight the need for the company to carefully manage its supply chain and inventory levels to mitigate potential disruptions. That concludes the financial summary for Waters Corporation. Feel free to comment below, and I will be happy to answer them when possible.